Today, we're going to be talking about required minimum distributions. They're mandatory, but penalties are optional. I'm going to show you how to avoid both the frustration and the fees in this episode.
Welcome to Financially Fluent with Ray Godleski of Southeast Wealth Partners.
Today, by the time we wrap up, you will know exactly when different RMDs are due, what to do if you slipped and missed one, and how to use your RMD in a way that actually strengthens your retirement plan instead of blowing holes in it. So, why do RMDs matter more than ever? And we have to kind of zoom out for a minute here because people are living longer. Some are retiring earlier, some aren't. But the balances inside of those traditional IRAs, old 401ks, are bigger than ever. And all that growth is wonderful until the IRS steps in and says, okay, it's time to share, right? And so let's start off with what is an RMD, or really what is an RBD, which is required beginning date. That is the deadline for taking your very first required minimum distribution from traditional IRAs and retirement plans. The penalty for missing an RMD used to be horrible, 50%. Today, it's only 25% penalty, and if you fix it quickly, maybe 10%. But I think a discount on punishment is still a punishment. Let's not let that happen, because those penalties could really pay for a nice trip to Europe or something fun versus going to Uncle Sam's coffers. So this is why you can't wing it. You need clarity on timing of accounts and all your options. So we'll cover what are the different types of RMDs. So there are different ones. So we're going to break this down. That way you don't have to memorize any IRS tables. But traditional IRAs, those RMDs, which is required minimum distributions, thanks to the Secure Act, your RBD, required beginning date, is April the 1st, the year after you reach RMD age. So if you're wondering, well, what age is that? If you're born between 1951 and 1959, your RMD age is 73. If you're born 1960 or later, then your RMD age is 75. I fit in that category. So once you hit RMD age, but like I said, currently that's 73 for most people around, you really got until December 31st, the year you turn 73, to go ahead and take that minimum distribution out. If you miss it, right, and you wait till the following year, so in this example, April the 1st of 2027, then you have to double up. You're going to have to take out that minimum distribution at the beginning of that year and then again in 2027. You want to keep that in mind. So even though it's a special rule, which sounds generous in case you forgot, you've never done it before, do realize that now you have created two RMDs in a single year, which is a way that you could really get knocked up into a different tax bracket, could mess up your IRMAA Medicare surcharges. Now, if you're still working for an employer-sponsored plan that you're putting in a 401k and you don't own 5% or more, you could delay it some if you wanted to in that situation. But once you're retired, the clock starts ticking, and the thing for executives to remember is each old 401k has its own RMD. You're not able to pull those together like you could with an IRA. So if you had, 3 or 4 different IRAs, you would have a RMD calculation for all 3, but you could take the distribution from just one of them if you wanted to, or 2 of the 3. So again, you want to make sure you're keeping up with any kind of orphaned Ks that are floating around out there, like a gym membership, but because they all have their own required distribution. Now, what about inherited IRAs? Those have RMDs, right? And so with the Secure Act, that changed things. It introduced a 10-year rule. So to give you an example, I had a client, been with him a long time. Dad passed away. His dad had already started taking RMDs. So therefore, his account, even though he's in a good income bracket right now, right, working hard, making good income, now he's got to take those dollars out over a 10-year period, and he's got to take a minimum out over those 10 years. Whereas the brother, who also inherited half the IRA, the brother was able to stretch it out over his life expectancy, so over a 40-year period, because he was able to qualify under one of the exceptions. So there's still a few exceptions out there with inherited IRAs, but not very many. And then, of course, for the surviving spouse, they have a lot of options. So we'll cover that in another episode. But for a surviving spouse, they truly do have a lot of options. But the bottom line is the inherited accounts, the inherited IRAs, They're very different than you would have thought about just 5 years ago or even a couple years ago. The IRS has certainly introduced something new to us. We want to keep our eyes on that. The 10-year rule, could it be a 5-year rule? Or what happens if the beneficiaries aren't updated? So there's really a lot to unpack there. Again, we'll probably cover that in another episode, but I want to get over the basics with RMDs today. So, well, what if you did miss an RMD? Because this can happen, right? Let's just say the scenario I gave you, the dad passed away in November, and maybe his intention was to take an RMD out in December, but wasn't able to do that. And so, the grown kids, if you will, may be thinking of a lot of things and not do that. So let's take the fear out of it. What happens if you miss an RMD? Step one is going to be take the distribution out immediately. Don't fret over the exact date. Just get it done. Get the RMD out of there. Step two would be filing a Form 5329 with your tax return. And then step three is going to be requesting a penalty reduction or a waiver. So the IRS will often waive the penalty if you correct it quickly and you can show it's an honest mistake. They really don't want drama. They really don't want paperwork. So you want to give them very clean paperwork. And most of the time, you'll be fine. So, it doesn't have to be something to lose sleep over. But don't pretend like if you miss, don't pretend it's not real, and it's just gonna disappear on its own. Because I do think the IRS tends to be pretty persistent, kind of like that. If you ever see a Roomba kind of bumping into the corner of every room, that's how I picture the IRS when you owe them some money. So now we could talk about some smart ways to take out your RMDs. Because you got to take it out. What are you going to do, right? So this is where you really want it to work with your plan, make it advantageous versus, hey, I'm just trying to avoid penalties. We don't want to be reactive. One of the things that you got to think about is, how often do you want to take the money out? You could take out the money in a monthly fashion. You're going to know at the beginning of the year how much are the RMDs, and you could just take a check every month, kind of like a paycheck, right? Other folks might decide they want to take it out quarterly, which can work out pretty well with their tax planning, kind of their cash flow rhythm, especially at retirement. And then the third way, of course, is annually, which is super quick and easy, right? Just boom, give it to me, and now I'm done with my RMDs. Should I choose to take out more money or convert some after that, you certainly can. And then some people do it towards the beginning of the year. Other people do it towards the end of the year because they have a better idea of their tax picture for that year. So now one of the things you could do that I'm always surprised by how many people are unaware of this, but it's called Qualified Charitable Distributions, also known as QCDs. And so with our podcast, you will hear an acronym every episode. I can guarantee that to you. Will you hear multiple acronyms in an episode? Probably so. And I'll try my best to explain those. So QCDs, Qualified Charitable Distributions, once you reach the age of 70 and a half, if you want to take money out of your IRA and directly go towards a charity or a church, you may do so, and that will not be treated as income because it went directly from your IRA to the nonprofit. So that age is actually 70 and a half, which lined up quite nicely back when RMD ages used to be 70 and a half. Well, so now let's just say you're at RMD age, right? And you want to start to satisfy your RMDs. You're already used to giving to a church or a charity. You could take that money directly from the IRA and go to that charity without it being taxable, yet still going towards satisfying your RMDs. So that's kind of a cute little way to not get your AGI too high, which could start to impact your IRMAA charges, which are Medicare surcharges. We're certainly going to get into Medicare surcharges in future episodes. As a matter of fact, it'll probably come up in a lot of episodes. It's something that people don't think about, especially in your 60s, but you really should think about how do we strategically plan around that. Now, if people are itemizing deductions, maybe the QCD isn't as big a deal. Could be. But a lot of people don't itemize deductions anymore. The standard deduction is quite high. It was doubled a few years ago, and for now continues to be quite large. So you definitely want to know about QCDs. What you can't do is you couldn't take money from an IRA, go directly to a donor advised fund, a DAF. So you can't do that. But some people want to reinvest their RMDs from their IRAs. And so You could journal that into a individual brokerage account or a joint brokerage account. You could do that. It's still going to be a taxable event. You're still going to get a form that says that you made that income for the year. But what you can't do is you can't go directly with your RMD into a Roth IRA, unfortunately. So can't do that. Doesn't mean you can't still convert to a Roth, but you're going to have to meet all the RMDs first. Then you can convert more to a Roth if you wanted to. I have seen some people buy real estate later in life. They know about the step up in basis with real estate. And so, if the RMDs are quite large and maybe, quote, don't want to spend it, you could invest it into real estate. So you're already paying tax anyway. So that's certainly an option. I've seen people convert life insurance, or they had maybe a permanent policy and they just want to use the dollars from their RMD that goes into their checking account to kind of help fund those. Those are certainly things that can be done. From a withholding standpoint, most people don't really realize your RMD withholdings count as if it was withheld evenly throughout the year. So what this means is, let's say you didn't do any withholdings early in the year, out of that IRA account. You got a chance before that end of the calendar year to take another distribution and maybe specify a very high amount so that you don't get any kind of penalties when it comes to what kind of withholdings did you get for the calendar year with respect to your RMDs, IRA distributions. Certainly want to think about that.
And now a quick message from today's sponsor. This episode is brought to you by Southeast Wealth Partners. If you've been listening to Financially Fluent, you know we're all about making smart money moves, whether it's planning for retirement, protecting your family, or building long-term wealth. But everyone's situation is different, and that's where the team at Southeast Wealth Partners comes in. They take the time to understand your goals, your challenges, and your values. To learn more and connect with their team, visit southeastwealthpartners.com. Southeast Wealth Partners, your next step toward being financially fluent.
So the important thing here is, how are RMDs integrating into your plan? And even if you're not RMD age, I would say it's really important to be thinking about this. Once you're in your 60s, in my opinion, go ahead and start thinking about it. It reminds me of some clients we were working with going over that concept of RMDs. I don't remember their age at the time. I think probably 66, maybe even 65. I started talking to them. I said, you guys have pensions, you got Social Security, you have, pretty big account that hasn't been taxed on yet, right? Pre-tax account. Don't really have it. They had, at the time, had no Roth. They really had no brokerage accounts either. And I showed them how much RMDs they're going to have. At that time, it was 70 and a half. That was the age. And they kind of looked at me and said, well, we don't need that much. We're not going to be able to spend. We don't want to spend that. We don't want to do that. So you also don't want to pay 50% penalty. So, let's proactively think about what we could do. And so I started talking to them then about Roth conversions. And what's kind of nice about that plan was we're able to start to take money out of their IRA directly into a Roth conversion. We would do calculations based upon their income tax brackets. What would the projected IRMAA surcharges be if we didn't want to screw up their Medicare surcharges too much, maybe just a bracket, maybe go an upper bracket. So what worked out really nice about that was, if you think back to 2020 and 2022, when those markets were pulling back, when there was big drawdowns in the overall market, that was the time we would do a Roth conversion. Now, sometimes you can't get that kind of timing, but nevertheless, the more important piece was we started converting those dollars into a Roth. So what did that do? One thing is, it started to build up a tax-free bucket for them for their futures, giving them greater control. The second thing was that the pre-tax accounts, it was bringing those balances down some because we're taking money out of it. Now, the account did quite well, so it still grew in size, but not as much. So that, therefore, their required minimum distributions at RMD age of 73 are now a lot less than it would have been. Something you want to think about doing for sure is, is there a way you can kind of get ahead of it before you get to be RMD age? And one of the things that it's important, not just the tax, which again, we don't know, what are the tax rates going to be in the future? What are the tax brackets going to be in the future, right? Those could shrink, hopefully not, but it's possible. But also, I've noticed a lot of people just get a little bit not happy with Medicare surcharges. And so that's going to have it could have a pretty big impact on that. So as a matter of fact, sometimes I'll meet folks that are a little bit later in the game. They're already at RMD age, and you got to make that strategic decision. It's unique to each individual, right? But based upon longevity and a few other factors, do they want to take a very large distribution and have one bad IRMAA tax year so that they don't have to have IRMAA surcharges every year for the rest of their plan? Like I said, I think we'll cover this in a future episode. I know we're trying to talk about the basics with RMDs. The other thought is tax planning for who? So a lot of couples especially don't think about this, but it should. If you're a married couple, a lot of times you're tax planning for yourselves, right? For you two. What's best for you two as a couple? Unfortunately, a lot of people become a widow or a widower. You know, you're the survivor, and all of a sudden you're in a single tax bracket, and those tax brackets change on you, and usually the assets don't change that much, so your tax rate is probably going up. So you want to at least put some thought into what do the taxes look like for a survivor, and then for certain families, they want to think about, well, what about the tax implications to the next generation? So let's just say you're in a very low tax bracket, but you got your grown kids making good income, and then they inherit those assets, got 10 years to take it out. You know, that could have quite an impact to their taxes. So certainly important to be thinking about that. Who are you tax planning for? And it's probably going to change, right? Today you might be tax planning for two, and in the future you may be tax planning for a survivor or for the grown kids. You know, RMDs, they're not here to scare you, right? But they are here as a reminder that the government gave you a tax break for decades, and they just want their slice back, but it's probably a lot bigger slice, so they're getting quite a big share back, right? And so the trick is to make sure you're in control of the timing versus letting the timing control you. So you want to know your deadlines, clean up those old accounts, use strategies that align RMDs with the rest of your retirement plan, not against it. And if you want help reviewing your RMD timeline or want a simple 3-year runway plan that shows you exactly how to coordinate RMDs, taxes, retirement cash flow, reach out through the link in the show notes. You've really worked too hard to let a bureaucratic deadline trip you up. And if you have just other questions, feel free to send those in for our bonus episodes. Send it to info@sewealthpartners.com. That's info@sewealthpartners.com. I'm your host, Ray, signing off. Hope you have a great day.
Thank you for listening to the Financially Fluent podcast. Click the subscribe button below to be notified when new episodes become available.
This communication is for informational purposes only and should not be considered tax, legal, or accounting advice. You should consult with a qualified tax professional, accountant, or legal advisor regarding your specific situation before making any financial decisions. Investment advisory services are provided only in compliance with applicable laws and regulations. Ray's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. The information on Financially Fluent does not constitute a solicitation of the sale or purchase of securities. You should consult a professional advisor before executing a security trade or taking any other action based on information contained in this program. Securities and investment advisory services offered through Mosaic Wealth, Inc., member, FINRA SIPC. Mosaic Wealth is separately owned and/or other entities and/or marketing names, products, or services referenced here are independent of Mosaic Wealth.